Hello, accounting students. This is our video lecture series for chapter number 3, where we're going to be covering the topic of adjusting journal entries. Just like transactions we've recorded in past chapters, we need to now make sure our financial statements are updated, accurate. And to be able to do that, just before we prepare the financial statements, we need to look at our accounts and adjust them, either increase or decrease them to their correct balance. And we know from the past chapter, to increase or decrease an account, you need to know your debit and credit rules. So make sure you go back to chapter 2 to review those rules for increasing and decreasing accounts. In fact, let me summarize it here on this screen. So here's the rules to increase all the different types of accounts. All accounts. So if we're dealing with an asset account, we increase the asset with debits. And of course, the opposite of an asset that you own is a liability that you owe that are increased with credits. Expenses, cost that is used up, is increased with debits. And the opposite of an expense is the revenue you're earning recorded with credits. And if you pay out a distribution to the shareholders, that's called a dividend, recorded with a debit. And if you're receiving money from a shareholder because they're buying stock of your corporation, common stock, we increase the common stock account with a credit. So here's your rules of how to increase the different types of accounts. Of course, if you want to decrease the accounts, these three are decreased with credits, and these three here are decreased with debits. Now, when we prepare a financial statement, you usually are going to do that at the end of a period. And so far, I believe the company we were looking at was called Fast Track, and we were preparing financial statements at the end of the month. At the end of the month. And again, to make sure those financial statements are accurate, at the very end of the month, now we're going to be adjusting the account balances to their correct amount. There's other different periods besides monthly to prepare financial statements. For example, for the big public corporations, you typically hear in the news their profits, their earnings for every quarter. So again, before they come out with that report for quarterly profits, quarterly earnings, they will make adjustments at the end of the quarter. At the end of the quarter to update, especially their revenue and expenses that are the accounts that determine the company's net income or net loss. You definitely want to prepare a financial report at the end of the year, especially to help you prepare your income tax return. And again, just before preparing that report, you need to update your accounts, preparing with adjusting entries. Now, for most of us, when we do our own accounting, or for very small businesses, what they use is called the cash basis method of accounting, where they report their revenue when they receive the money, and they report expenses when they pay out the money. But this is not in compliance with the generally accepted accounting principle rules we've been learning. For GAAP rules, a company has to use the accrual basis method of accounting, where revenue is going to be reported when the products they sell, that's the merchandise, or the services they sell to their clients, are delivered. Yeah, all that work is done. Only then is the revenue going to be recorded. Also, expenses are going to be recorded. Here they say when incurred or when the cost has been used up, not necessarily when the cost is paid. Okay, so we're going to follow accrual basis method of accounting in our class, even though you as an individual or small businesses would use the cash basis method of accounting. Here's an example of why accrual basis method of accounting is important, and comparing it to a cash basis a method. So let's say your company bought an insurance policy covering 24 months, and it starts from December 1st, 2021. That's when you paid for this 24-month insurance policy. So if you were using the cash basis method of accounting, you would deduct all of that $2,400 cost at the time you pay it here on December 1st, 2021. But the coverage is only going to be covering 1 month in 2021 and 12 months next year in 2022 and the remainder 11 months in 2023. So if you use the cash basis method here, you would be over um, deducting the costs here being used in 2021, all 24 months, even though only 1 month's worth of insurance has been used up. And you would be understating the expenses for 2022 and 2023. So that's why cash basis here is not a good method to use versus the accrual basis. Accrual will allocate just $100 of insurance expense here, even though all $2,400 was paid in 2021, and $1,200 worth of insurance expense here in 2022, and $1,100 for 11 months here in 2023. Again, that's accrual basis. And we'll come back to this example in our next video. So here again is the rule for recognizing reporting revenue. Revenue, again, that's recorded with a credit, like we learned last chapter, is only reported when the goods we sell, that's the merchandise we sell. And we'll have 2 chapters dealing with selling merchandise. Or in the past couple of chapters, we've been selling services like consulting services. The revenue for these items is only recorded when we deliver the merchandise to the customer, when we finish doing the work, and not necessarily at the time we collect the money. The rule for reporting expenses says that typically expenses should be deducted or recorded at the same period of time that the related revenue was recorded. That's the matching principle, or matching expenses with the related revenue. Or maybe a simpler method of recording expenses is to record them in the period that they benefit. Like that insurance expense, only $100 should be deducted as an expense in 2021. Here it says that there's 4 different types of adjustments that you can do at the end of the period. And I'm not too concerned if you're able to classify these adjustments into these 4 different categories. What I am interested in you learning is how to record adjusting entries, be it any one of these 4 methods, knowing what accounts have to change, knowing whether it's increasing or decreasing those accounts, and knowing how to do it with debits and credits. So when we come back with the next video, we'll go through the general rule of making adjustments and also going through some detailed examples.